And then maybe lastly, Alan, with respect to your firm, Sharestates, and maybe your niche within the origination space, you're a little more focused on some of the transitional products and shorter term investor loan products. Any sentiments you'd like to share or observations that you'd like to share as it relates to how you've seen liquidity change and evolve over this period of time and how you've managed your way through that for the sake of your firm?
I'll echo a little bit of what's been said here. At our firm, we originate two core products. We have a short-term 12 to 24-month transitional product, commonly referred to as fix and flip. And then we also have a non-QM investor purpose product, which is a 30-year hybrid mortgage with arm periods associated to it. We don't originate anything consumer. And what we saw is very similar to what's already been described. There was about a short window, 90 to 120-day liquidity crisis from end of March leading into July, August, during which most of the capital markets world had shut down and stopped purchasing loans. So we have likewise been an originate to sell platform. We have our own balance sheet and warehouse lines that we have access to pre-fund our loans. We'll hold them on balance sheet for a few weeks, aggregate up, and sell to all different types of capital providers, from asset managers to hedge funds and private equity funds to big banks like Credit Suisse, for example. And ultimately, we rely on those takeout partners to continue originating to recycle our capital. So during that liquidity crisis, we had to do much like everyone else did, is we stopped lending for the most part. We focused more on asset management and played the wait and see game to see what the market was going to do. Is this going to be long-term or short-term? And ultimately, thankfully, there was quite a bit of stimulus that was pumped out by the government fast enough, which I think helped pump the brakes on what could have been a much larger crisis. Ultimately, we were able to come out of that in July, August, and start originating new product. And I think what we see now is actually a bigger demand than what we had prior to the crisis. I think, again, echoing some of the sentiment that we've already heard, these products performed exceptionally well. We were at the right attachment points relative to the 2008-2009 crisis. So we had good performance coming out of this crisis, or I guess in the middle of this crisis. And to compound that, there was a window of 3, 4, 5 months where originations had stopped. So supply and demand kicked in. And all of the investors that were out there used to purchasing forward flow weekly, bi-weekly, monthly basis, now all of a sudden had a backlog of cash and no products to deploy into. So I actually think execution and pricing in terms of where these loans are getting sold is better and higher for us now than it was pre-COVID, larger margins.
Yeah, that's great. Now, it's good to hear around the table that things have really restored themselves and are very orderly again. And there's a lot of options in terms of liquidity when you approach the space.